So, one of the issues was that, a lot of the money that went to AIG was used to either post collateral to counterparties or to make good on credit default swaps. And, there were several billion that went to Goldman. And then Goldman's CFO had a conference call with reporters to kind of stem some of the outrage, saying, look, yes, they paid us that money, but, we were sort of hedged against this. This was a bailout for us. This was not a bailout for us because we had hedged against this, and we weren't really worrying about that money so much. And I was at a conference at George Washington a couple of weekends ago, and a guy who's a professor at the University of Texas named Henry Hu, H-U, gave an interesting talk about what he called empty creditor syndrome. And what he means by that is when, in a normal situation, when, Jim, you lend me money, you're my creditor, I owe the money to you, and if I fail to pay, the consequences to you are fairly obvious, and so you'll be really worried about that. But in this new world where you could then go out and hedge your risk and buy credit default swaps, it's as if that $1 million you've lent me isn't really $1 million liability to you because you've insured against it. And so that your behavior, if I start to go bad on my debt, might not be what you would expect from a typical creditor in that situation. The Washington Post had an interesting article that touched on the same topic today. In their business coverage, it was about Six Flags, the big amusement park company that has, Dan Snyder, who owns the Redskins, owns it, and they have a horrible capital structure. They're $100 million in debt. They're basically saying they're trying to engineer a debt for equity swap outside of bankruptcy. But there's one bondholder, and they think it's Fidelity Investments, that owns about $100 million of these bonds, and it won't come to the table. All the others have sort of agreed. And one of the theories in the article was that they actually want the company to file for Chapter 11 and formally default on the debt because they had bought credit default swaps against it. So they're refusing to participate in this, what would seem to be the rational thing to do because they are an empty creditor. And I guess the question is, has the,
It's the new rationality. We have the old rationality, but we have these complex, somewhat complex financial instruments, which are sort of jumbling, behaviors, relationships, risk-reward ratios. Who's taking the risk versus what their reward is, and I tell you, I was somewhat mildly surprised that in all this financial reform that the White House wants to do, that they didn't take a much tougher line on these credit default swaps. At the very least, trying to limit these credit default swaps to people who actually have a little skin in the game, people who are actually involved, not people who are just speculating on whether someone's going to go bust. But no, they're actually going to keep those. And I found that a lot of people are concerned that a lot of especially people on the left are concerned that this administration is still too centrist, and and I know people I talked to, that was one thing they pointed out, that this they're very worried. Larry Summers, is the Clinton administration, former Clinton Treasury Secretary, and that they have not taken a much tougher line on these instruments.
Well, so what is the proposal with? Because I was a little distracted last week. What is the proposal on the table with credit defaults? They just want
I think it's really just a central clearinghouse. Want to make sure that keep an eye on these things, but don't necessarily want to limit them. You also have a similar situation with hedge funds, because they want to have far more hedge fund registration. And it's in a way, let's take the case of hedge funds. It's very difficult, I think, to make the case, that they shouldn't be registered. If the whole theory before was that you had these very sophisticated investors who could keep a good eye on the hedge funds, and they knew where their money was. And of course, with the Bernie, Madoff scandal, people who had money, people who were supposed to be very sophisticated investors, and they still found themselves being taken to the cleaners. And now, obviously, since the Madoff scandal, you've seen a few more of these sort of Ponzi schemes, all of which were made, seem to be made good when the market's going up, but not so much now.
The better rationale for forcing hedge funds to register is not for the protection of, their fat cat investors and the, institutions like endowment funds that invest in them. I think it's more for the system. In other words, by forcing them to register and provide more disclosure about what they have going on, then, we won't be as surprised when it turns out somebody's been writing insurance on, $500 billion in corporate debt and has no ability or willingness to make good on those payments, which then has, systemic implications. I mean, that's basically what happened with
right.
AIG.
And certainly we have a situation where we're not going to let these institutions that are so-called too big to fail. We're not going to take the, the 1920s Andrew Mellon liquidationist school, where we're just going to let things fail and see where the cards land. Obviously, if we're going to do something, then we should know what the potential risks are going to be.
Here's what I don't get about the credit default swaps issue. It seems like if these were traded on exchanges, the Chicago Board of Trade, Chicago Mercantile Exchange, one of those derivatives markets, and there are a ton of derivatives markets and exchanges around the world for whom this would be really good business because they're always looking for new things. And of course, to protect themselves and the players in their markets, all those markets require people, if you are trading grain futures or gold or whatever the thing is, you can't just say, I'm taking a position of $100 million in cotton futures without putting any cash up. You have to put a certain amount of cash up, and that prohibits any one person or institution from taking positions that are too big. Why are not the exchanges either banding together or the big ones coming together and saying, let's put credit default swaps on our platforms. This is a new line of business for us, and basically we will enforce the type of requirements that would have prevented AIG from happening.
I very much like your more free market approach to regulating these credit default swaps rather than the a regulatory reign of terror. I didn't really expect to hear this, Dan. That doesn't sound like the worst idea in the world to me. So maybe we should move beyond credit default swaps. Is anybody still watching this? After 10 minutes on credit default swaps, is anybody?
Credit default swaps are hot.
I know they're very hot for at least people in the 212, maybe 202 area codes. For the rest of the country, they've probably been credit default swapped out.